When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current event headlines, also what you may be missing from your retirement portfolio. We'll answer listener questions, and then finally, retirement moves to make before the year ends. My name's Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Fogan of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
I am doing fantastic now that I'm talking to you and, of course, all the fine people here of the greater Tucson area. Well, Jeff, we had the government shutdown. It looks like it is all over with here. The markets are riding a real wave right now. Optimism is waving over the market. Do you think that this is going to carry over here through the month of November, December, and maybe into next year? In other words, what does the November market really look like most of the time, and has this resolve to the government shutdown help things?
I don't know. I think the typical non-sophisticated investor probably thinks it did, but if you think about it, the market pretty much shrugged off the government shutdown in the first place. There was a couple of glitchy moments and some sell-offs, some profit-taking and some maneuvering, and I think some gamesmanship by Wall Street to put some fear into the market to make people sell, and then they can buy back cheaper. That's kind of how they do it. Gold and silver sold off really hard, and more so even the miners and the producers of the gold and silver. But they've been up over 100% in the last year, and gold and silver been up, 30 or 40% in the same time. I mean, there was due for a correction. There's also a lot of talk about the AI stocks being overvalued and historically overvalued. We've known that for a long time. Shoot, they were overvalued 2 years ago. I mean, they're even more so now. Some of them are actually turning in earnings because of the hype. A lot of companies have been making purchases and buying and paying in advance for services and things like that have shown up to the bottom line of some of these companies, making them look like they might have a chance. I mean, certainly, even though the AI bubble looks, and it is a bubble, I believe, does look a lot like the dot-com bubble that bombed. The difference is the dot-com companies had no earnings, had nothing but a dot-com after their name, and AI actually has some earnings. The problem is there's really not that much AI to go around. There's so many people thinking they're going to get a big piece of this big market share, and everybody assumes the same market share. 100% is still 100%. It can't get cut up in as many pieces and somehow become 300 or 400% growth. So I think there's a lot of hope and hype built into the AI market, and that we've seen a little bit of weakness and choppiness in that market. As far as November goes, November is typically a good month because it's a rebound month. Unfortunately, we didn't really have much of a sell-off other than some choppiness, especially in that precious metals market. But if you look at the indexes, there was no severe correction. It was just kind of a little profit-taking opportunity, I think, and an excuse to do so. November typically is a good month. There's two reasons. One is because it's usually coming off of a bad October, which may not be the case this year. It was a decent October, not a great October, but there certainly wasn't a market crash like in some of the big market crash years. We have window dressing, which is typically companies like to hype up their stocks at the end of the year. Also, a lot of companies make huge purchases because they want to blow the rest of their budget. Let's say they have an IT budget of XYZ amount. Let's say it's $10 million. They've only spent $5 million of it. Well, they got $5 million to spend. Otherwise, next year, the budget says you get this much per year. And if you don't spend it, then obviously you didn't need it last year. They'll probably cut your budget next year. So they hurry and spend money near the end of the year. So typically the final quarter of the year shows up looking pretty decent, I think, because they expect earnings to be okay. And that also remains to be seen in January, February, when the earnings come out for the fourth quarter, and we see if it really happened. But again, there's some window dressing going on. A lot of companies, even mutual funds and things like that, try to pump their funds by buying certain stocks, the ones that they can control, sometimes with a small float, or sometimes with their real popular stocks that are being hyped across the board by, let's say it's Fidelity, and they're buying Microsoft for all their growth and anything funds. They might just go on a binge to buy, and they could pump that stock up, which helps all their funds, and it might help the market in general look good because it's one of those big Magnificent Seven stocks that is a big part of the market. They could do that with Meta, Google, and some of these other companies as well. So again, there becomes a little bit of gamesmanship at the end of the year to make sure that they finish on a good note generally. That doesn't always happen. What could happen is there could be liquidity crunches, which is if there really is no liquidity or if banks don't have money to buy their own stock back or companies have run out of cash because they've already spent it on buying their stock back during the year, they aren't able to maybe do some of that window dressing and pumping up their own stock in the end. Sometimes the Fed will create some liquidity at the end of the year to help the banking industry finish on a good note as well, create liquidity. That's basically quantitative easing. However, we just got feedback from Jerome Powell that he's more likely to quantitative tighten because inflation still is around 3%, not 2%. Hasn't come down to the levels they want to, even though inflation isn't crazy like it used to be. It's really not gone up in spite of the tariffs and in spite of all the worries that we've had since Trump took office almost a year ago. Yeah, a lot of what ifs. So, I mean, every year is a little bit different. There's some trends that people count on. I don't know that we can count on any trend. These last few years has been really abnormal. Fundamentals have not been anywhere to be seen as far as why you would buy or sell a stock. It's just pure momentum and pure hype, it seems. And when that's ruling the markets, it's really hard to say what norms are going to be present and what norms are not going to be present. I don't think there is a normal, but again, historically, November's been a good month. Is it going to be a good month so far? I don't know. It seems like the government finally reopening is going to be a positive thing, but is it going to make the market go up? I don't know. For the last several months, we've seen hedge funds totally selling tech stocks and AI stocks, taking profits. Yet the unsophisticated investor, the Main Street investor, buys into the hype and continues to buy, continues to prop up their 401ks with max contributions, getting matched by their employers and creating more buys and aggressive type funds that are mostly slanted towards the AI and the tech area, which is where most of the growth is happening. So if the money dries up or liquidity dries up or the Fed starts tightening and takes money out of the market, I think we're going to see a recession in the next, an obvious recession. I think there's several indicators that say we've been in a recession from the standpoint of job creation, kind of stagflation almost. GDP really isn't growing at a robust state. We've been raising some money with tariffs. That's good. Trump says he's going to give some money back to the non-high income households. Nothing wrong with that. I guess part of the government reopening deal is to continue to subsidizing some of the Obamacare families that otherwise would have had to pay more for the insurance. I know my kids would have all been affected negatively by the new thing. So, there are some positive things. I think the Democrats put their foot down, I think a little too hard on the $1.5 trillion to give healthcare to everybody in the world, regardless of citizenship or need, and continue to pour money into programs that I think fund their backdoor enterprises that they own as non-governmental entities that supposedly help these functions get performed. I think that's how a lot of politicians get rich, unfortunately. And I'm not saying that cynically, and I'm not saying that as a conspiracy theory. It just is what it is. Doge found that to be true, and that's been a suspicion of mine and many others for many years. It's really sad to see where your taxpayers go and see the politicians get richer and richer. And even when the government shuts down, they continue to want their piddly little salary while they're making money on the side, and they want to pass bills that continue to pad their net worth and retire in hundreds of millions of dollars in net worth when their salary's $175,000 a year, like the Pelosi family and many others. Now, many of those people, granted, had businesses. Some people were very wealthy before they went into politics, and I don't fault those. But the people that went in with nothing and come out with huge money, I know are gaming the system. And unfortunately, we're still getting the system gamed. The fact that the government's at least open, I think, gives some sense of, even though they're probably stealing money from taxpayers and spending on things we don't necessarily agree with, I think it might give the market or the people that are investors a certain sense of calm that at least this isn't carrying forward another month or two. So given that, I'm hopeful, I'm optimistic. I'm also very, at the same time, skeptical. I am very wary and very concerned that as soon as some of these shenanigans that are being played to prop the market up may be turned against us, the typical investor, I want to be aware of that, always vigilant, watching the market and making sure that we get out in time if that starts happening.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about current events, what's going on in the headlines. Our phone number, 520-780-9059. 520-780-9059. If you want to give that number a call right now, set yourself up with an appointment with Jeff to talk about your journey towards a confident retirement. It's the Premier Retirement Roadmap at no cost and no obligation. Once again, 520-780-9059. Jeff, let's talk interest rates now. The 10-year Treasury yield has climbed to around 3.9% as investors feel a little bit more confident. What does that shift mean for both bonds and stocks?
Well, interest rates going up mean bonds go down. We expected, honestly, I expected a year ago I could buy the bond market and make 10% just in appreciation based on the fact that Powell was saying we're going to lower interest rates and it would flow through, even though he only lowers short-term interest rates. There should be some follow-through with the longer terms in order to keep this inverted yield curve true to what it should be, uninverted. And we really haven't seen that. What we've seen is other countries maybe been selling bonds because of the weak dollar or whatever, and trying to make some money, but it pushes the price of the bonds down, which actually makes interest rates go up, which again does curb inflation because it makes it harder to buy things. but it hurts the economy. There's less GDP growth. There's less true economic growth. People suffer when they have to spend 7 or 8% to buy a car or a house instead of 3 or 4 or 1 or 2 like it was for a while. I'm just not seeing the interest rates going up. This typically means that the economy is growing at a robust rate and we need to curb inflation. We really don't have inflation, but if we lower interest rates too much, we probably will. But the only way to make the interest rates go down is basically increase purchasing bonds. So as we increase bond purchase, or we have to buy bonds up and be willing to take a lower rate and be willing to hold bonds. And I think that's what happens typically when the market gets scared, when more people get scared, when maybe Main Street gets scared, because now more than 60% of households own stock, which has been the case for over a year now. And that's typically what happens right before a crash, when there's more Main Street investors than Wall Street and hedge fund investors and institutional investors. They're what they call the dumb money. That's no offense to people that invest in the stock market. Most investors, if they have money to invest, are very smart people. They're just not smart when it comes to understanding the tricks of Wall Street. I mean, we're outsiders. I'm in the business, but there's a lot of stuff I don't know. I have to kind of try to peek behind the curtain, and I don't know who's really spinning the wheels back there on Wall Street. I'm not those guys, but they use us as advisors, sometimes as tools to their own benefit. So we have to be careful not to be used and abused, and we have to be wise and see what's really happening in the market. I think when it comes to interest rates, typically the Main Street investor has to want to buy bonds. In other words, it has to get to a point where they're scared out of the stock market, then the bond market will probably be propped up, interest rates will go down, which usually accompanies a recession and a stock market crash at the same time. It's hard to push interest rates down in a good economy without causing inflation. So the Fed really won't lower interest rates until they know the economy is really kind of in trouble, and typically they come in late. I think the economy's been in trouble for about a year, maybe, well, actually more if you look at the leading economic indicators. It really hasn't been, but it's been propped up by quantitative easing and fake money creation by not just the Fed, but another money creator that has created a lot of problem, I think, with inflation and just the fakeness of printed money is the crypto world. And that is, in my opinion, just an abomination to any type of money supply control or any regulated monetary anything. As far as dollar values, I don't even understand how you can control dollar values if you're switching the value of a dollar for a Bitcoin or anything else and trying to somehow get them on par with another or figure out what par is. And then what do you do with that other money? I mean, half the people are doing it in black market trade, so it's not showing up in GDP, or is it? We don't know. Is it being converted to dollars? We don't know. There's a lot of that I think is causing inflation or causing us to be in a position where even though the economy can be bad, it may not look quite as bad because it looks like there's some wealth out there. People think that there's wealth out there. The wealthy people do. And the wealthy people will continue to get rich, even if there is a market correction. But Main Street has to want to buy bonds. And so far they don't. They want to ride the hype of the Wall Street ride. They're still jumping on the train. It's going full speed and everybody wants to be on it. Nobody knows when it's going to crash, but eventually it will. Even though the Fed can lower short-term interest rates, they don't really lower the long-term interest rates unless they want to buy a bunch of bonds, which they could do. But how do they do that? Basically, the government's not printing any more money and banks are using all their money for stock buybacks. There's really not a lot of liquidity out there to do it either. So they're going to have to figure out a way to get through what's probably a tough time to come, given that everything points to a recession, and it has for a while. The market does what it does, and it will do what it will do, and it will have to do what it has always done, and that is to correct and to crash and to reset. That's why they call it a recession. We just don't know when it will do that. You can't time the market, but you can also know when to be more cautious than not. And if you're money preservation mode, now's a scary time to be all in the market. I think if you're a super long-term investor, you can be, or make sure that the money that you don't have to live on month to month is the money that you use for the market to try to get some of this last upside that might be here. And I don't know how long it'll last. Could be a few months, could still be another few years. I have no idea how long this crazy market can stay crazy. Interest rates are a big part of it. If interest rates go down, typically it's because the economy is bad enough to make interest rates go down. Interest rates going down, if they're manipulated down, create additional liquidity, which typically helps the market. I don't think that's going to be the case as we go forward. I think we're out of that realm where they used to kind of print money the last several years and make the market go up because they create fake money and fake low interest rates. And then they had to raise interest rates because inflation got out of hand. And now we're in that middle of the road mess where damned if you do, damned if you don't. You have to print money, but you can't print money. What do? You print money and cause inflation, or you do quantitative tightening, get the inflation under control or keep it under control and crash companies and crash economies and possibly crash the market. Well, if you look at hedge funds, you look at institutional investors, looks like they've divested about 30% of their holdings in tech stocks of some of these high flyers. They're taking profits, and that might be a sign of what's to come, that it's getting closer, not farther away. And we need to heed all that information that we get from what's going on in the market.
Talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about current events. And in just a moment, I want to shift gears, Jeff, and talk about what you may be missing from your portfolio. But before that, I want to remind you that Jeff, of course, is open and available for you, our listeners, to give him a call right now and set up your appointment for your Premier Retirement Roadmap. Doesn't cost you a dime. 520-780-9059 is that telephone number. You can make that call right now. If you're looking to preserve your wealth so you can have a better retirement, you want to create an income stream that you can count on, maybe reduce taxes, the Premier Retirement Roadmap may be the answer for you. Again, no cost, no obligation. Make that call right now at 520-780-9059. You can also find out more about us online at premret.com. That's PREMRET.com. Jeff, a lot of investors think that they're well diversified because they own a mix of stocks and bonds, but you say that's only part of the picture. So let's dig into what might be missing here. Many retirees and investors feel confident because they hold that blend of stocks and bonds. Why might that not be enough in today's environment?
Well, especially in today's environment, there's two things that could happen. If they do have to do some quantitative tightening, which they've actually started breathing those words again, that typically makes bonds go down. If you look at the 20-year Treasury, I think it's down over 20% from its peak a few years ago still. And it has bounced back a little bit, maybe 5 or 10% in the last 6 months. But over the last year, it's still been pretty flat. If you look at shorter term bonds, maybe they didn't go down as much, but you haven't made as much money on those bonds either. Stocks have crashed pretty hard back in 2022. They've been propped up by money printing and hype on the AI markets, it's a good thing to have something to grab onto and something to believe in and something to bet the future on. And I think AI is where it's at right now. Energy that goes along with that is a big part of it as well. We'll see what happens there. I think when you hold stocks and bonds, both of them we know can go up and down in sync. Recession, stocks are going to go down, bonds may go up a little bit, but I don't think we're going to get the offsetting returns on a bond portfolio unless interest rates go back down to 1%. I just don't think they're going to go back that low. I think if they do go down, if they're in the 4 range, they might go down to the 3 range, maybe even a 2.5 range at the worst case scenario, because I don't think they want to create a situation where they have to overstimulate the economy and go $30 trillion more in debt over the 38 or so that we're already in debt. So we're kind of in a catch-22. We've made a bed we're sleeping in. Some people think that it can go on forever. Why bother? We just do QE to infinity if we never have to pay off the debt because we can always print money to pay it off. Then what's the problem? As long as you can do it during my lifetime, who cares, right? Well, eventually somebody's lifetime, like your kids or grandkids, somebody's going to have to pay. And I think it'd probably be sooner than that. But many of us are going to see plenty of corrections and plenty of reset because sometimes these bad fiscal tactics do end up coming back to haunt us. If we look at credit cycles throughout the world, even back to the Roman Empire and to the last several recessions and things that have happened around the world, not just the U.S., but Ray Dalio is a big student of the credit cycle. And he says we're like at the end of a credit cycle where bubbles pop and crashes happen and bad things happen and we reset. And guess what? We all get through it. People don't die from it. It's not a mortal issue, but it is a financial death for some. It's not everything. And that's when we realize, hey, it's not all about the money. We get through a lot of hard things. And some things might be monetary. The rich typically don't get hammered. It's typically the middle class and the poor that take the brunt of it, but it is a cycle that happens. So we have to keep that in mind. The fact that if all your money is in a traditional diversification of 60-40 split, and it all can be at risk, and you're using that money, especially if you're in a retirement situation or pre-retirement situation, then you're basically betting your entire retirement on something you can't control. I believe that true diversification is to diversify out of those things that you can't control and put things in places that you can control to the standpoint that you get the peace of mind and the confidence that you're going to get a paycheck for the rest of your life, regardless of what happens in the economy. And there are companies that can do that. There are insured, secured accounts that are principal protected, that guarantee income, no matter how bad the market gets, no matter how bad interest gets, no matter how bad the recession gets. And if you consider moving some of those assets out of risk, because Wall Street is nothing but risk. In fact, it's interesting. Everything on Wall Street is a security, and the root word being secure is exactly the opposite. If it's a security, if it's even called a security, it has risk. Isn't that weird? If it's a security, it has risk. I think it's really a play on words that the industry has put in there in order to somehow subliminally make us believe that this is the safest place to keep our money. And there's a lot of rich people that have never had to take a loss or because they've got big pensions or big income or big cash flows from real estate or an inheritance or something, or a pension, where they've never really had to rely on their stock and bond portfolio. And for them, maybe 60-40 is fine. You can let it ride because you don't care if it goes up or down. It's not going to matter because in the long haul, it'll probably be higher in 20 years than it was, when you started this program. Problem is, what do you do during the next 10 or 20 while the market's going up and down? Are you spending that money or are you just letting it ride? If you're letting it ride, then you have less to worry about. Most of my clients, even though we deal with the mass affluent client, the people that have at least $1 million or more and millions in retirement cash, still don't want to live their lifestyle and rely on losing half of those millions or something in the next market crash and locking in losses while they spend money as they wait for the market to recover. If you took half of that retirement and put it in an income stream where you can guarantee a six-figure income, let's say $10,000 or $12,000 a month, guaranteed to at least cover the basics, and then you had the rest to decide on how you wanted to invest, you'd be in a much safer position. I mean, that's what I've learned over the last 35 or 40 years. I don't know how long I've been doing this, almost 40 now. The people that have remained the happiest are the people that don't get greedy and don't have that FOMO, the fear of missing out. Like just because somebody else made a bundle on NVIDIA and risked a lot to do so, 10 years ago, we didn't know if NVIDIA was going to be that great of an investment, or we would have just, if we had a crystal ball, we would have just put all our money in it, right? Some people did and got lucky. Some people put all of it in Apple and got lucky. Some people, I've met people that have tens of millions of dollars in just one stock because they just bought it and held it through the long haul, and good for them. But sometimes I'd rather be lucky than good. But you also have to be responsible when it comes to money. Diversification is the name of the game, but it's not just diversifying to risk stocks. I think diversification is the different type of buckets. There's the bucket that can go up or even pay income on a steady basis, whether it be dividends or interest in stocks, bonds, dividends, stocks, that kind of thing. But there's no limit to the downside. If markets crash or things sell off or the dollar gets weak or bonds default or whatever, you could lose that money. Insured accounts, there's secured accounts that I consider are the best for income. They have secured, you can't lose money. Your upside is limited, maybe, sometimes it isn't as limited as you might think. And we're talking about the LIRPs and the fixed index annuities that we love. Those are insured products, insured by insurance companies that have a boatload of cash, of extra, what we call the legal reserve plus a surplus, which is typically hundreds of millions, sometimes tens of billions of dollars in excess cash laying around, so that if the market takes a dump and you take your money out, they're not locking in your loss. They're taking the loss, and they've got longevity on their side. They're going to wait it out. These insurance companies have been around 50 or 100 years. They're in it for the long haul. They're just growing their assets, and they're providing you and those other users of those products income. And for the amount of people that they have as clients, only a small portion of them are actually receiving income from those investments. So you're basically offloading the risk to your portfolio to a company that's stronger than any company on Wall Street, as far as financials go, or any bank that you could put your money with. And as far as the financial security of an insurance company, they're so heavily regulated and so safe, several levels deep. In addition to insurance funds to recover assets if lost, even though they've fixed insurance companies historically have never provided losses to any client that I know of. I've never heard of it, never read about it. I've searched all over about it. Nobody can show me a time when somebody lost money in a fixed product in an insurance company. And there's just levels of insurance and security on that. So why not put the money you need for income in something like that and diversify into an income stream? Oh, what about your taxes? Sometimes when you have a lot of money in the stock market, stocks and bonds, they're spinning off dividends, interest, which are always taxable. Sometimes we can gauge what that's going to be, but we never know what the stock market is going to do. If you sell out of a position or take profits, you're going to have a tax. Sometimes you use mutual funds that are not in IRAs that might have capital gains, and you don't even find out what that is until after the first of the year. So how about using some diversification that doesn't have to do with just making money and paying taxes as you go, but either deferring taxes, which you can do on annuities, or eliminating them altogether, like you can do on a Roth IRA. You have to pay taxes up front on that money, but you never pay tax again if you set it up right and don't abuse it. And the same with LIRPs, life insurance version of a Roth, which we call a Roth on steroids. Because on the LIRP version, you never take your money out. You just borrow on the continued growth of that product. And you don't have to buy a ton of insurance to play the game. In fact, the cost of insurance may be less than you pay on a mutual fund or to your advisor. If you look at the long-term effects, good and bad and ugly of all these different products, they all have something, either limited upside, unlimited downside, fees, something, cost of doing the business, because everything has a cost and a benefit. When you weigh out the costs and benefits, I think you'll find out tax-free savings with unlimited growth and continued growth and compounding growth may generate more income from you than even a very well-managed Roth IRA, and leave more to your heirs at the same time. So there's different ways to skin the cat. It's not all stocks and bonds. Wall Street would love for you to think so, because they continue to trade that money. They get money off of every transaction called the spread. They get different kind of fees and things that go along with sometimes 12B1 fees, sometimes management fees, sometimes operation and expense charges inside of a ETF or a mutual fund. And the last thing they want you to do is move half of your millions of dollars in retirement, or let's say your $1 million or $2 million in retirement, move it to something where they never get paid again. So Wall Street hates everything that's not a stock or a bond. And when you hear that everybody touting that on TV, realize that it's Wall Street companies that are paying for those advertisements. And they're basically dictating what they can and can't say to you on TV. And the cheerleading goes on, trying to help keep you in the market and scratch each other's back in that regard. So again, consider the source of all that information that you're getting. Have an open mind. Look at other options. There's so many tools out there You wouldn't build your own house with just a hammer. You need a saw and a few other tools as well. So use all the tools in the bag. Build a financial house that's right for you, that you're comfortable in, and that serves all your needs.
Jeff, I'm sure that based on our conversation that our listeners may have some questions. If you're concerned that your portfolio is not truly diversified beyond just stocks and bonds, I want you to call us here at Premier Retirement and talk to Jeff. 520-780-9059. No cost, no obligation for this Premier Retirement Roadmap Review. 520-780-9059. We're also online at primret.com. Jeff, let's take a break. When we come back, we've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premred.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you listening to us each and every week. You're listening to Premier Retirement here on 790 KNST, Tucson's most stimulating talk. Of course, we're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. If you've missed any part of the show today, remember we're also a podcast. You can go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. We're also on the air for you 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. No matter when you're listening, the phone number is the same, 520-780-9059. Hear anything that piques your interest today, you'd like to talk to Jeff, get your Premier Retirement Roadmap. No cost, no obligation. Call that number. You can do it right now if you want. 520-780-9059. Leave your name, telephone number. Shelley will call you back during the week and set up a time that is very convenient for you. Time is wasting here before the end of the year. Why not get on the right path before 2026 strikes? And again, it's not going to cost you a dime to do that. Okay, Jeff, time for listener questions. Gary is listening to us in Oro Valley. Gary says, I'm 67 and about to retire. I'm married and my wife and I are empty nesters. Between both of us, we'll have about $4,500 a month in Social Security. We also have about $800,000 in an IRA and $100,000 in cash. How do I know how much income I can safely withdraw from my investments each year so that I don't outlive my nest egg?
Well, if you're in the traditional 60-40 investment mix that we just talked about, or if you're in the traditional stocks, bonds, or even a laddered bond portfolio, if you're going to get 3 to 4% on laddered bonds, then you better only pull out about 3 or maybe 4%. If you're in a bond and a stock portfolio, even though stocks average more than 4% over time, history proves and volatility has proven that statistically you can't pull out more than 4% per year without having a chance of running out of money, especially if you're in the mid-60s and live another 25 years. And that was a 25-year retirement. That only puts you at 90. You know, if you're healthy at age 67, one of you and your wife are going to live past age, or a 40% chance one of you is going to reach past age 90. So you may need more than a 25-year plan. And let's just say you need a 30 or 35-year plan. Don't know if your wife's younger or older than you, but about the same age, you probably got at least 30 years in you. So you might want to dial that back to maybe a 3% rule of thumb if you want to leave all your money in volatile assets. So if you want to leave your future based on hype and hope and what ifs and things that aren't guaranteed, then you're going to be like, probably 70 or 80% of the people out there that invested in a 401k, they keep it the same and they just, there's hope. And most people just live on a tight budget so that they never run out of money, and they live like misers and then end up having a bunch of money because the market didn't crash enough times. But the fact is, if it did, that's the only way they would have been safe. So why not find the happy medium? Let's not live high on the hog, but let's say 800,000, at a 4% rule. Let's just use that. Just to say you're going to keep 100,000 in cash to have for fun and emergency purposes and so forth, and you'll probably continue to add a little bit of your income from that. But let's just say you turn the 800,000. And by the way, I wouldn't put all $800,000 into a fixed income type product, but I'm going to show you what the difference is. A 4% rule, and that's really aggressive anymore. It's been proven somewhere between 2 and 3.5 by every expert in the field that has revisited the William Bengen 1993 model, which was the 4% rule and has been kind of used as a rule of thumb for a long time. It's also a little self-serving for the stock brokerage world to say you only should take 3 or 4% out per year because, of course, they get fees and they want to make sure that that grows. And the more money they keep under management, the better it serves them, not necessarily you. My opinion is I like happy clients till you die, and I want to be around for a long time, and I want to see you around for a long time and see you smiling for a long time, which means I'd like you to be able to spend your money. 4% rule at $800,000 is about $32,000 a year. So there's another $2,500 a month after tax, maybe-ish. So now you're up to $7,000 a month in livable income minus a few taxes. I guess Social Security is going to be minimally taxed now. You get a little credit on that. So let's just say your taxes may be somewhere between $5,000 and $10,000 max. Not bad. So you can live on $60,000 or $70,000. However, in an indexed annuity, you would be able to guarantee income of over $60,000 a year, plus your $4,500. Now you're over $100,000 a year, 100 spendable and guaranteed, even if that account goes dry. Now, there are some accounts that have built-in strategies that have proven to return pretty solid returns. Maybe that $800,000 is still intact, and maybe it's even doubled or tripled in value by the time you die, and you still get your $50,000 or $60,000 a year, but it's guaranteed. Best case is if the market's really high right now and it tanks a couple of times in the next decade, like it did when it was really high in the .com era and busted in 2000 and 2001 and 2, and then it got busted again from the bank crisis in 2008, not even 10 years later. That whole cycle, that double cycle, took 14 years before the stock market ever got back up and stayed above what it was in the year 2000 before the crash started. So 14 years of choppy down markets, up markets, down markets, and going sideways while you're spending money. That's going to ruin your estate plan or your income plan. And that's why the 4% rule really has to be taken into consideration. What if you could make money in all the up years during that 14-year period and not lose money in all the down years and have twice the income the 4% rule would supply for you? So again, find that place that you're happy. I think the index products that guarantee income, for the peace of mind that it creates, I'd rather see you live longer, happier, than die rich and live like a miser and just make somebody else rich when you die because you didn't run out of money and you had a bunch just in case.
Gary, thanks for that question. Once again, our phone number, 520-780-9059. If you'd like to get in and talk to Jeff, we appreciate you listening to us in Oro Valley. Okay, let's go to Jerry now in Catalina Foothills. Jerry says, if I die first, how do I safeguard my spouse's financial security, both investment income strategy and estate planning, so they're not at risk of losing lifestyle or equity?
Well, there's a couple of different ways. Some of the things like I just talked about with Gary's question was these index annuities don't have to be single life annuities. You could actually turn it on so that your $1 million, you put half of it into something that generates $40,000 a year for both you and your wife. So if you die first, she still gets the $40,000. Now, keep in mind that whoever's the survivor is going to get the highest of the two Social Security benefits. So let's just say, Jerry, your benefit's $3,000 a month and hers is $2,000 a month. Well, she would lose hers and get yours. So she still gets the, let's say, $4,000 a month from the income annuity you set up with your IRA money. She still gets the $3,000, and now there's going to be a shortfall. Well, maybe that's where you have the other half of your $1 million. And I'm just using that as an arbitrary number because it's just an easy number to, you might have a lot more than that or half that or less, well, whatever. The concept is still the same. So whatever you do have left that's not generating income for you, then you leave it in an account that you can grow. You can either grow it slowly, or you could even set up an account that generates income in the future for that spouse, and it's guaranteed to grow it at a certain rate. There's one out there right now that gives a nice income bonus up front, and it grows at over 9% per year, guaranteed the longer you wait. So let's say you're several years older, and I don't know, but let's just say, Jerry, you're in your 70s and your wife's 15 years younger than you, and you know she's going to outlive you. And you say, I just want to take my IRA, but let's set this other IRA up in my name, but knowing that she can do a spousal assumption, inherit my IRA, and then turn income on based on her age 15 or 20 years down the road, which would be at a growth rate of potentially 9% or better, depending on what product you use. Let's just say you do one for $500,000, you just let the other one ride. Now she's got maybe $1 million, $1.5 million by the time she turns hers on, which means she's going to get maybe double the income, maybe more than you're getting, which will more than cover the Social Security, more than cover inflation, and give her some options. She doesn't have to turn it all into income. She could actually take some out in cash and fix a house or do some things or buy a new car, go on a trip, and maybe hang out with the kids more, whatever. Bottom line is you just have to divvy up the assets into buckets for each of those things. When we do an income plan, we show certain asset classes or asset buckets. We put them in columns on a spreadsheet. You can call them buckets if you want, or just call them columns, asset columns or asset set aside that is purely for growth. We love to have a Roth IRA, the growth asset that would create income for the spouse. You know why? Because when you die, the spouse is going to have a horrible tax bracket compared to what you have if she lives. Your spouse would have a higher tax bracket filing as a single than you would as a joint married couple. So you want to have as much tax-free income go to that person as you can. And that's why people still use life insurance for income replacement in retirement. We like to use LIRPs, life insurance retirement plans, not just for income replacement, but for lifetime income or tax-free income, even while the person is alive. So if you were healthy and you put it on yourself, you would have tax-free income while you live, and whatever's left in that life insurance policy would move tax-free to your spouse. She would either be able to, cash it in and maybe pay off some debt to increase cash flow that way, or turn it into a tax-free income program for herself. So a lot of different ways to skin the cat. You didn't give me enough information to build you a plan, but if you came in with that information, you would see how we would line that out and make sure that both you and your spouse are good to go till at least age 100. And we could get you feel pretty comfortable about it because we do use guaranteed income products and very low assumptions on the investments that we use. And we've typically gotten much better results than what we estimate. We'd rather underestimate and overperform than overestimate and underperform. So, we'll go give you a nice conservative estimate. We'll give you some guarantees, and we can even guarantee spousal income after you're gone.
Jerry, good question. Thanks for listening to us in Catalina Foothills. And as Jeff said, we do need a little more info. So if you would, give us a call here at Premier Retirement, 520-780-9059. We would love to talk to you and get you started there. Okay, Frank's listening to us in Tucson, Jeff. Frank says, I'm nearly 70, and I'm wondering, I'm heavily invested in U.S. tech stocks. Will a tech stock crash wipe out my retirement? What do you think?
Well, I don't know. Is your retirement based on those tech stocks? Is this tech stock just fun money that you're playing with? Do you have a big pension that pays all your bills? Do you have Social Security? Do you have no debt where you could live on just your Social Security paycheck? Well, if so, then nothing's going to wipe out your retirement. You could lose everything and you still have income. But if you're used to living on $150,000 a year and over $100,000 is coming out of those tech stocks based on appreciation, you might be able to do okay. I mean, I've seen people that have lived very nicely on one stock like NVIDIA for the last few years, but there's a tech stock crash and NVIDIA starts getting some competition. We know companies like AMD and Intel and Taiwan Semi, a lot of semiconductor companies out there fighting for that same AI business. And we don't know that NVIDIA is going to be the superpower that's been over the last forever. It may, and it may continue to go up. It may just not go up at the increments that you've been used to. I don't know how much you have in savings. I don't know how much of those tech stocks you should take off the table, take profits. You never get hurt taking profits, by the way. And we know that tech stocks are up handsomely. And if you took the money off the table, you'd probably still find out that you made a nice average rate of return for the rest of your life if you're 70. Even if you diluted that into the next several years of your life and only made 5% on your money from here on out, you'd find out that those tech investments turned out to be pretty wise in hindsight. Thing is, we never know. Those are also the ones that crashed the hardest. In 2000, the tech stocks of the dot-coms bombed 80% plus. That's what the NASDAQ went down. If you can handle an 80% crash that takes 14 years to get back to even, then you're already in good shape. But I don't know the rest of your financial story. So if you are living on that money, I'd say, I'm not going to call you crazy. I'm just saying you got to rethink your strategy because it could turn out making you feel a little bit crazy if the stock market did crash and did something similar to the 2000 crash. Was a doozy and it came back. Now we've had a lot of quantitative easing and money printing and things like that have kind of, I guess we could say we're in new times. And it's different this time. That's what John Templeton said was the most dangerous words in the investment world is it's different this time. It may be different in the way that it looks and feels, but the results could still end up being the same. That could be financial devastation if you have all your eggs in the tech basket. Do I think you shouldn't have any in there? No. Put as much in tech that you feel comfortable risking or losing half of and waiting on. But if it's time to take some of that money off the table, you never get hurt taking profits. And if you can use that to solidify a nice, happy, healthy, confident retirement where you can sleep at night, then I would suggest considering that.
Frank, we appreciate you listening to us in Tucson. Sounds like, as Jeff said, you put all your eggs into pretty much one basket. So diversification is going to be a key here. We're going to continue that conversation here in just a moment about alternative investments. But again, you can talk to Jeff by calling 520-780-9059. You can make that call right now. Leave your name, telephone number, and Shelley will call you back during the week and set up that appointment for you. 520-780-9059. So, Jeff, I want to continue this conversation that we started about alternative investments, and we talked about stocks and bonds. What are some of the other alternative investments that you did not talk about in the first segment that I think people really should consider?
There are some private equity. We actually offer private equity investments where companies will go out and just buy a lot of debt and collect that debt, basically, and give you a big piece of it. We've got some that generate a dividend of around 10 or 11%. The price can go up and down like a mutual fund can, but it's a nice income type alternative. You have to be an accredited investor generally to participate in that type of investment. Some of the other alternatives are you can kind of even build a self-directed REIT if you want to with real estate, if you feel so inclined. And we don't really do real estate, although my son is into real estate and mortgage, still has his licenses and helps people typically get out and reposition assets if need be. But that rental income, there's nothing wrong with having rental income that generates appreciation on the asset and income over time. Generally. However, keep in mind that type of an asset in retirement may not be conducive to your peace of mind because it's still a job. When you're out doing work on a house, fixing toilets or painting or chasing down renters for money or trying to refill the place with a new renter, that does take time and effort, and it's not always the most fun activity people like to do in retirement. So keep that in mind. There's a number of different assets that you can consider besides just the stock and bond world I mentioned. Some can be just set up on a personal lending. My son came from the real estate investment world, and we're actually putting together, don't push us too hard, it's going to come, but don't know when, not next week, but we're putting together real estate because personally, I invest in a lot of real estate debt, mortgages, hard money, and things like that. I used to give money to fix and flippers and things like that because that's my son was in it and he had tons of contacts. And every time I had a little bit extra money, I could throw some that way as just kind of another diversification measure. I still have annuities and LERPs and managed money, all the things that we do for our clients. I have that too. But on the side, there were some private investments. Now there's enough of them out there that we could box them up into a multi-million-dollar asset class and have people participate in them 100,000 at a time or whatever, again, for accredited investors, and you can get some income that way. So it doesn't have to just be stock and bond. It depends how brave you are to go out on the limb and try something new or find out about it. Bottom line is there's a lot of different things out there that Wall Street doesn't want you to know about. The main ones were the ones I talked about in the last segment, but those are a couple more.
Okay, so stocks, bonds, and as far as alternative investments go, where do insurance products fall into this conversation, Jeff? Is that something that most everyone should have some part of?
Well, I think so. In the segment before the question segment, I guess that was the first segment, the end of the first segment, we talked about the index annuities. Those are insurance products. Life insurance, of course, is an insurance product, also can help create a backup income for a surviving spouse. And those are alternative investments, but some people don't want to call them investments. But the fact is when you put your money in it and expect some sort of a return, that investment could be either risk management, it could be actually a return based on cash flow, it could be a return based on growth, could be a return based on tax savings, whatever it is. Those, I believe, when you park your money for some benefit, it's an investment. You could even call an RV or a car an investment. You're trading money for something of value that you think is of value. Of course, most financial advisors say it's a horrible investment. Well, it is if you're trying to appreciate money, but if it's trying to create pleasure and peace of mind and fun in retirement, there's nothing wrong with that. So, keep that in mind as well. Insurance products are just another alternative and another institution that you can park your money with, but have a lot less of the angst and the gut aches and the headaches. You can kind of remove a lot of that from the fixed side of the insurance business we use, which is more the guaranteed. There is a side called variable, and they're trying to even pretend they're fixed by saying, oh, we're buffered. The most you could lose is 20%, and the most you can make is 20%. Well, why would you go into something that has this, the equal downside is equal upside? I'd rather have half the upside and none of the downside and have your money last longer. If you do the math, that's what will happen in a real market over decades. So again, insured products, they are what they are. They're insured, secured, guaranteed. They create more guarantees than risky stuff does, period.
Jeff, what about things like structured notes or managed futures? And I know you talked about private credit. Do they fit into a balanced portfolio? Should they be part of almost everyone's portfolio, or when should we use something like those?
The securities business, those structured notes are not risk-free. They still have risk, but they're buffered. They still have downside. I would prefer an index product like the LERP or the index annuity more. They're a little more conservative. Structured notes have been pretty good. As long as the stock market goes up, structured notes are basically built on a bank saying, hey, we'll give you 14% interest, and the security of this note is going to be, we're going to buy options on Tesla, Goldman Sachs, and Broadcom stock. And they'll have like 3 stocks in there. If any one of these stocks is down more than 20% over the next 3 years, you don't get paid your dividend. And if at the very end of the term, if any one of these stocks is down more than X percent, could be 20, 30%, then, well, you only get 20% of your money back, or you have a loss. So you could get interest, maybe 7 or 8 or 10 or 12% interest on a note like this for a few years, and end up at the very end getting 20% of your money not returned. So there is a risk element in them, even though while the market's been hot and heavy the last few years, they've become a lot more popular. So if you heard of structured notes, the brokerage industry likes them because they can trade them like a commissionable asset. They get called from time to time, and so they get to reissue them and get another 3% commission or whatever it is. They can kind of keep turning them over and over. Yeah, I'd probably make a lot more money if I sold more structured notes. We do have an outlet for structured notes. We can buy them. We can set them up if you're interested in doing something like that. I just don't think they're as efficient as a lower fee cost product where you just invest a smaller amount of your assets in those 3 stocks. You take the good, the bad, and the ugly with it, but you protect the assets with no downside and still make a pretty good portion of that guaranteed return, but with no risk. So again, there's different ways to strategize, but yeah, structured notes is a good one. Some people do like covered call option strategies and income strategies where they're buying and selling futures and calls. We buy ETFs that do that are kind of an algorithm-based product, but those are still considered securities. Those are still in that stock and bond realm. So they're still in that risk asset class. So I didn't really define those out of that because those are products like mutual funds, ETFs, stocks, bonds, structured notes. They're still a security, margin or leverage trading, futures, options, and other sophisticated things going on. And sometimes we use them if the market's right. But that's something that most people don't really know about. We've had a lot of experience in those. We know when the risk is too high to bear, and we know when we ought to stay away, and we know when we ought to try them given certain market conditions. But those are, again, good question. Those are still in the securities bucket.
So, Jeff, how do we put all of these alternative investments together?
Well, it's a lot easier to see on a spreadsheet, but I'll try to describe it to you. We've talked about the income planning process, the 5 pillars that we talk about. We talk about the income plan, but the investments have to support that income plan. Everybody needs income in retirement. They don't have a job anymore. They don't have that paycheck. So we need to create paychecks. And we also need to create play checks. Everybody wants to play. Those play checks could be guaranteed income, or they could be met with, some of the risk assets that you might want to have because you still have that feeling that you want to get up to the plate and swing for the fence every once in a while. So you might have some managed assets, and it depends on how much you have in IRAs, Roth IRAs, 401ks, and things that are deferred rather than post-tax, and those after-tax dollars that you might have in a brokerage account or a bank account. So you can get just basic fixed interest on a CD with some of that money. That could be one of your income buckets, but that could be and maybe some of your bank money. It's always there if you need it with relatively no penalty if you had to get out early, but every so many months it renews. You have some savings account. Then maybe on some of your other brokerage account, you want some tax deferral, you want some growth without risk, and maybe you do a principal protected product that doesn't have any downside, but can make 10 or 12% in a good decade. If you back test it over the last few decades, that's what it would have averaged if we could have bought it back then. So you can still make decent rate of return, but not pay taxes until you actually use that money. And that would be money that you could structure outside of your estate. You could also use some of your post-tax money that you would otherwise have in your bank or your brokerage account outside of your IRAs. Maybe buy some notes on homes or find some real estate investments that would generate some income, or a private equity investment that has a 10% dividend, and the private equity is out buying assets at a discount so that they know they can make money, they can make their margins and make the owners happy, but have plenty for the investors, and maybe even generate some double-digit returns. Keep in mind that that asset would be taxable as you go as well. Then maybe you have some managed money that is also taxable as you go. Now, after you've done your bank and your non-IRA money, let's talk about your IRAs. You want to create cash flow from your IRAs. The thing with IRAs that I don't like is that the longer you put off taking money out of that IRA, the bigger the account will likely grow, which means the bigger the amount the IRS is going to force you to take out when you're in your 70s. And that's called RMD, required minimum distributions. What I like to do with structured IRAs, if they're going to be taxable in the future, is let's just levelize the taxes, figure out how you can take maybe $40 or $50 or $60,000 a year out of that IRA on a guaranteed basis forever, and have that be just a flat rate, so you know that you're going to pay tax on $60,000 a year rather than nothing now and then $60,000 a year when you're 73, and then $100,000 when you're in your 80s, and $200,000 when you're in your 90s, and then you end up leaving your kids a couple $1 million in an IRA that you could have spent more of earlier on, and they end up having to pay taxes on it, and they have to take it out within 10 years, and they might be in a high tax bracket. It might end up being half the money gone by the time you get done paying the government their share. So my opinion is you use each different asset type in a different type of a product. And I've talked about these alternatives for that purpose. Now, I mean, you might have some Roth IRA money that you don't plan to ever touch, but that would be ace in the hole money that you want to leave your kids or your spouse when you die. Let's invest it. Let's be aggressive in that. If you have a couple $100,000 that you've started an IRA with in a Roth, and let's say you can make 10% a year on it by being fairly aggressive, that money's going to double every 7 years. So let's just say you live 28 more years. That means it's going to double 7, 14, 21, and 20. It's going to double 4 times. So 200,000 goes to 400, 800, 1.6, actually $3.2 million in 27 years if it averages 10. If it averages 7, it's going to be a little less than that. But think of that. You can actually spend all your taxable money at a low tax bracket and allow your investment money, your stocks, bonds, and more aggressive risk money that you don't have to touch for income, and let that be your legacy that you leave on a tax-free basis, more favorable, a lot more soft landing for your kids when they find out what you leave them than leaving them a big tax bill and a bunch of money you put off paying taxes on because you wanted to live tax-free, and you just forced them into a higher tax bracket. Let's just live at a low tax bracket and keep them at a no tax bracket. So again, it's just about lining up those assets in the different buckets, using the different tools, the alternative investments. We still like stocks and bonds for some of your money. Not all of it. If you've got big pensions, maybe so. But if you don't, most of our clients that come here want some income. So we want to set aside those assets that are appropriate for income, guarantee that income, give you the peace of mind in retirement you need, and live life on your terms rather than the terms of whatever the market deals out that year.
Jeff, I hate to interrupt you, but we're running short of time this week. Once again, Jeff Vogan can be reached at 520-780-9059. If you'd like to request your Premier Retirement Roadmap, no cost, no obligation, 520-780-9059 or online at primret.com. Jeff, out of time for this week. Thanks so much for your time, but most importantly, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Vogan, I'm Jeff Shade. Have a great weekend. Talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.